Morning, everybody. Welcome back to the Opportunistic Trader. It is just after 11 o'clock on December 6th, and we're joined now by Brynne Kelly of the Fundamental Angle and Mike Korn. They've been joining us regularly to talk about all things energy, really taking us through a lot of different topics in the energy market. And there's a lot to talk about today, so I'm really interested to hear from them. And I'll let Brynne and Mike take it from here.
All right, great. Welcome, everyone. Good morning, Mike. How are you?
Hey, good morning. Really good here. Thanks. How are you doing?
Oh my gosh. We could talk for 2 hours, right? It's like the brain is jumping everywhere. But so we just had the crude inventory numbers coming out. So let's just get to that really quick because I know everybody's looking at that. In the upper left-hand corner, I show this week's crude change versus prior years. And in the lower corner, I have the natural gas, which that number doesn't come out till tomorrow, but it's still interesting to look at. So let's take the oil inventories. I want to kind of preface this with saying there are a lot of big macro themes being tested and played out in all of these markets this week. So the minutia of inventory at the moment almost seems small in comparison. But at the same time, there's also so many macro themes being tested that it might be time to kind of step back a little bit and maybe take a look at some broader positioning looking forward. So I think that's what Mike and I are going to do today. We're going to go through some of the numbers and then take a look at some of the curves and talk about what we're seeing out there, how the market's reacting. So oil, we had a total draw of 2.8, although crude oil without SPRs was a draw of 7, a little over 7. And that's kind of continuing with the trend we've had this year. The difference is that people really look at the demand areas being gasoline and distillate and also Cushing, the benchmark storage area. And we certainly built a little bit in Cushing and built in gasoline and distillate, which you would expect as refiners are coming out of maintenance and running full throttle again. Looked like exports were up a little bit too. So overall, I'm not sure it changes the picture. And this is the picture. So this is looking at year-to-date storage in inventory changes from week ending November 30th versus prior years. And the main trend that really hasn't changed was the huge build that we started to see in 2015, started to ramp that down in 16 and then reverse in 2017. And here we sit in 2018, year to date, basically unchanged for the most part. Down 15 in total, but it's a build a little bit in crude and a bit of a draw in the products and in Cushing. So if you want to thread that into the macro themes that is really out there in crude and the question, it's about supply and inventory. And this particular number this week doesn't change the uncertainty. Is this going to be a year where we start? Is this the start of a building trend again, or is this more of a normalization? And that's years prior to 2015. It's kind of a little bit of build, a little bit of draw, generally kind of flat every year. The system is generally operating. And then, bam, you introduce shale. We build into the whole system, take a couple years to absorb that, work it off, give price signals to all the producers out there. And so here we are. So many people concerned that will look like 2015 again. Mike, you and I have talked about the return of contango to the market. Yeah. And certainly one of the things that helped the big build in inventories once shale came online was the contango in the market. And it's small at the moment. Nobody would say that there's some great storage incentive, but how much, what will that lead to as far as inventory? You probably have seen some of the back contango this morning, Mike.
Right.
I haven't taken a look at it.
I'll just point out Cal 19, 52.30, 52.35 actually bid, and Cal 20, 53 even bid. So good 75-cent discount, Cal 9 under Cal 20. And that's that's about the biggest discount we saw. We saw that last week when we spoke also, right about 75 under. I agree with you. It's an incentive, but still quite a small incentive, relatively speaking.
It's a small signal, but it's not. It's still that's an uncertain level, right? All the spreads in general are at uncertain levels, and the thing to remember is that any storage level doesn't equate to a price in the market, but trends, equate to bull bear sentiment.
Right. Because you and I have seen through the years, regardless of price level, from $10 to $15 to $110, we could have backwardation or contango.
Absolutely. Yeah. And if this weekly inventory, it really it hasn't added anything, overall to change the picture, but it is, they're all cumulative, and we're just not getting a cumulative look at the moment, other than we've reversed the massive withdraw from storage that we had in 2017, and that backwardation really played a big role in. And so I find it hard to get at $50, $51, after we've had this big move down, to say that this week's number, or actually year to date, supports any big sentiment from here, bull bear. It's, okay, now what? I guess we all wait for the OPEC, more clarification on that. However, well, let's look at this first. So here are where overall inventories stand. Green on the far left is this year. So we have Cushing, gasoline, distillates, and crude oil. It's certainly not the natural gas picture where it stands glaringly that we're really behind averages. I would say it supports status quo, but a beware, right? We're certainly not at levels that indicate we should continue to support the markets. Geez, trip all over my words on that.
I'm thinking maybe with our markets, we should beware of the status quo.
Oh, that's a good one. Right. Yeah. Right. And the status quo right now is that it's bearish.
Yeah.
And actually that's a new status quo in the last month or so, right? A different status quo. And and that's really, I think, what we're going to get into a little bit here today, Mike, is just thinking through recognizing when a macro theme has arrived. And by that, I mean, options have fully priced in the uncertainty around it. Now the fixed price is reacting, and it's probably time to look further out on the curve or look for positioning in the development of a new macro theme.
You're saying that with both crude and natural, right?
Absolutely.
Yeah.
Absolutely. So let's take it first here. Let's look at the crude curves. Yeah. I always like to take a look at the whole complex so I like to look beyond just the benchmark contract and see, if anything stands out. And, the interesting thing is we've had big moves in the oil markets in the last 1 to 2 months, well, really all year, kind of up and then down. But for the most part, from a spread standpoint, things look as they should, right? Brent leads the market. We saw a little bit of time earlier in the year when the Dubai Oman contracts were a little tighter to Brent. Now the curve is discounted a bit more. We've seen during this year where LLS, the spread to Brent was a little tighter. Now it's a little weaker.
Right.
But for the most part, things are relatively in order, except for when you look down at the Permian. And in both markets, the Permian on this graph for oil is in pink here, WTI Midland markets, and you can see how heavily discounted in the front it is to Cushing. And the same thing is clearly noticeable when you look at the gas complex, and that's the aqua colored line bringing up the rear here on the future strip in natural gas. And as in both complexes, the premium demand centers are pricing in the real demand. Anywhere from in natural gas, you've got the East Coast and the West Coast pricing well above, East Coast at $12. You got California, been very volatile. They've got a very tight situation there this summer. And then, you got the Permian sitting here. Geez, in April futures for the Permian are 84 cents.
Whoa.
Last night, at least. And I mean, that barely has been able to get above $1. So you see that. And then again, you see the same, I should have had this one in aqua on here too. That would have been easier. You see the same thing here, right? You see Midland heavily discounted, and it weighs on the market, right? You have this, you want to put out some themes of demand, and you look at export numbers, and you look at refining, and you look at where prices are clearing in the cash markets. But then you have these outliers in the US in both gas and oil. And it's a lot of supply that it's in a lot of ways stranded. In oil, they have more progress on pipelines coming online. And for sure, you can see that in the curve here as we get out to 2020. You almost get Midland, at least in the future spreads, right? Looking like they're pricing even over WTI, by the end of 2020. And that's all based on people's expectations of pipelines coming online so that, you get that oil to market. But it's a limited, stranded market in that they can only produce as much as they can take away. And oil gets limited even more by they can only produce as much as they can take away the associated natural gas, whether it's flaring, which, they're up against those limits all the time, or whether it's pipelines. And there was a pipeline that came on last month, and, it gets filled up, and then you're kind of back in the same discount, right? The discount might move a little bit, but then there you are again. And the same thing in natural gas, although you can see there's a lot less expectation here for the pipeline construction. And realistically, pipelines that are slated to come online in the gas complex are really to take gas either out of the country, in both cases, to Mexico, or put it on a ship as LNG and take it away. So in that way, it's less available supply to the US, and it's a little bit less of a threat. In crude, you can feed it in to the overall system and easier to transport. I guess the bottom line here is that until we get this Permian low price environment off the table, it's always going to weigh on prices, even though it's stranded, because it's potential.
Right.
We have this supply that's out there, and imagine you could say the same thing about the Canadian supply, right? That they've had to curtail, their government actually has had to curtail production. mandate, production curtailments because they just don't have the infrastructure to handle it.
Was that what last week was about? I think they cut, or earlier this week, something like 300,000 barrels a day.
Absolutely. And I think, that I think they ratchet up, throughout towards the end of the year. And really that's just more, it's potential, right? It's potential to be there if prices go up and support the cost of transport. That's been such a big thing with these discounts, right? $10 discounts to Cushing. Is that, if we get a narrower spread or we get higher prices, you could get more coming on the market. And that's just sitting out there waiting. And I would say, to me, that weighs have more heavily to me in both markets than even OPEC.
Yeah. How do they transport some of that oil in Midland? Is that by train, by trucks? And does anyone monitor that? As far as like how many trucks are, being leased, et cetera?
Yeah. So I'll give you a general answer, Mike.
Okay, cool.
So
I just want to get the mobile app for that. So.
Let's say pipelines are full, and we certainly saw, as new pipelines takeaway capacity comes online, it fills up. There's a lot of barge and rail activity and truck, but rail is limited by capacity. Everything fills to the extent that it can, and then waits for a new price level to support. Trucking is expensive. You can't put as much on a truck as you can flow through a pipeline. The insurance, the certified trucks, same with rails. But for the lack of certified rail cars that could take it away, they'd be taking more away. So if these spreads narrow, you're just going to incent, you're going to bring more of that to market. The higher price, the less discounted that oil is, the more they'll pay to get it to Cushing or to the Gulf Coast. So there's a lot just sitting out there, but it's not an easy fix. Infrastructure is expensive and it takes a long time. So meanwhile, the market sort of considers what the schedule is, and you can see that in all pricing curves, kind of what the schedule is of, pipelines coming online. You see the futures curves try to reflect that. And then the spread is one thing. You could have Cushing and Midland flat. Let's say you can see it's pricing that flat, the spread in 2020, but that could mean that Cushing is $36 because you just have that much more supply heading, there, which is why the spread is something people are more interested in than what, the outright price direction is for that. The spread could be flat with prices at $80 or, at $20. If you can move the product. So, and then just one other curve sort of complex to look at is crack spreads. You have on top in the gold, you have the heating oil cracks, and you kind of bring up the rear gasoline cracks, and that always has a seasonal shape to it, kind of like natural gas does. And, I always find if a market is so bearish because of gasoline demand, for example, you'd expect those cracks to go negative, or much lower than they are. And I would say these aren't at top end of the range where cracks have been, but they're not on the bottom end either. And it's hard to find a signal within that as far as, there's still an incentive for refiners to make product. Whether or not it covers their costs is a different story, right? I mean, but if you have an asset, you're going to run it, because owning it is, you already paid that option premium. So now you're going to trade around it, right? So the bottom line is there is a margin. Whether or not it's enough margin is a different story. And, you know, that takes a while to play out. So I guess, Mike, what would you say, though, in general, the theme is the entire complex has been moving up and down together.
Mm-hmm.
And so it's, at some level, it's almost the moves are a little disingenuous, you know?
Yeah. The way I would characterize it, I think more natural, but also crude. With crude right now down $2.50, looks like they're taking another shot at the low of 50.23. But the way I would characterize it, especially with natural, since we last spoke last week, we do get rallies, they just don't hold. And so even though we're in natural gas vulnerable to storage and weather, the market just cannot sustain rallies. Seems like every day, except when the December natural went off the board, I think it was Friday. It's like every day, whether the market's lower and we have a rally, or whether we start firmer, we rally, it gets sold into. And
yeah, and you know, I think you know, that what that made me think about is over the years when we've had these big price shocks, and you know, of course, the more recent one has been in oil, but it's certainly happened in natural gas. You get a demand reaction to it. And those cycles are coming a little bit quicker, right? It used to be that, you know, gas prices were high, gasoline, you know, that's what you paid. And after a while, you changed your driving habits. Now, all of a sudden, after this, you know, the big run in 2007, 8, you know, to 150, we have penetration of electric vehicles.
Right.
And so people get more and more nervous of the upside moves, because I think the demand side has gotten smarter and has more options.
Yeah, along with what you pointed out, you know, the trend is, you know, that way.
Yeah. Yeah. And I mean, I remember in the late 90s, you know, when electricity was first being deregulated, I mean, the prices, it was insane, the volatility, you know, and the upside, you know, thousands of dollars of moves within a day. But that doesn't happen as much anymore, because utilities got a lot smarter on how they price things and how they, to their customers, and what levers they could pull, instead of serving demand at all costs. They learned that there are cheaper options that you can pay someone to not use, and that's cheaper than serving, you know, actually supplying them with the product. And I think that continues to mute upside potential in commodities, and it's really technology, the availability of data, and what high prices have done to consumers. And so I take a look here. I have over the last, it's, you know, since 2012, it's this next chart, it's natural gas, the daily cash prices, right? And we've looked at this before, and how boring of a summer it was, stuck in the same range it's been stuck in for the last 4 or 5 years.
Yeah.
And finally, you know, the bright green line is 2018, and you know, we got this breakout, and that was something, you know, the market was positioning for. Let's say, you know, the story has been out there that inventory was low, and it was just a matter of, you know, when will the market react to that? And you know, that we'll call that was a macro theme, right? That everybody was positioning for and waiting. And when that move happened, right, when we got this move up to above $4.50, almost $5, it was pretty epic. And there were all the stories, right, that you typically see when prices blow out. We saw volatility blow out, and yet now we've just So we made that move, and we, for the most part, we're going sideways since then. And I think this morning, the last time I looked, implied volatility was already down to like 76 or 77, down, we'd reached up over above 100. And, people get really hopeful and pay enormous amounts for call options. And now that premium's just being destroyed.
Right. And we talked about last week, it's not necessarily you go out and sell vol, because there's still a lot of risk. There's some bullish fundamentals, but we're seeing some of that premium disappear. But even before we saw that, we spoke about this last week a little bit, is that the market, the natural gas market, just getting quotes for the first quarter 19, where all the volatility was, it's so much easier right now. Market makers are much faster with their markets. They trust their models more. It seems like we've been more calm and normal than the option premium implies in some of the natural gas strikes.
Great. Absolutely. Yeah. Great point. I mean, the one thing that has stayed is the call skew. Yeah. Nobody wants puts, there's just literally, even at these levels, right? People just aren't afraid of the downside. But it may, so we had this rapid move up, which really, changed or inflated volatility. And now we're adjusting, as you're saying, to these levels, and people are comfortable making markets again. In no way does that mean now it's time to sell options, right?
Right.
It just means that, now we had the move on the story that we have low inventory. It got cold. We saw the market react. Everybody got validation that yes, that matters. But we would need a new catalyst to move from here. Just regular cold winter in December, and for the most part, is just going to be enough to keep us moving sideways.
Yeah, you mentioned call skew. I just wanted to illustrate that call skew, but this is actually something I priced up earlier. Was the April lock or summer 19? At the time was 286.90. Let me just see if I think it's pretty much still there. Yeah, so this is probably very accurate. Maybe not precise, but pretty much where the market is for the April lock, trading at 286. The 250, 325 fence is costless. In other words, the 250 put is 36 cents out of the money, and the 325 call is 40 cents out of the money. So you'd expect the put to be a little higher than the call, given that it's not as far out of the money as the call.
Yeah.
But given the richness of the natural gas call strikes, the fence is costless. Again, that's a 250, 325 fence with the price of about 287.
Well, and a couple things to point out on what that little example you just gave, Mike. One is, I always assume that everyone knows this, but I think it's sometimes good to go through the explanation. Yeah. For the most natural gas trades in two main strips, summer and winter. Summer is April through October. It's a quoted strip. People look at that as a completely different thing than the winter strip, November through March. And right now, obviously, we're peeling off 1 month at a time in this current November-March strip. And so the next season that people will look at is the April-October for 2019. The other thing is look at where prices have the box that they were in, for previous summers and previous years. The market is literally pricing that fence around that range, right? Right. Between that 250 and 3.25. And that seems to be a very comfortable range for producers to get for their product in the summer. However, that brings me to, as we're talking about this macro move played out and we need a new catalyst to move winter prices outside of this now $4 to $5 range. And that's either going to be extreme cold or lack of cold, right? That is going, to take us really from here. And probably, I mean, you see these markets during the day, they're just erratic. Futures are. But if we look at summer, so this summer strip, and I like to look forward at some of these things and put some of these positions, just put them away in the portfolio. These aren't, things that are going to play out tomorrow. But they're also, when they do, if you don't have something on, you'll miss it. So this next chart that I have on, I looked at the colors. The colored bars here are the end of winter inventory levels. So that's essentially the first week of April. Where are inventory levels in the past, several years? And, you can see that the futures for 2019, currently, I think as of last night, settled at 1325. Nobody's really willing to step out and say that it's going to be any different than the level that we ended up last year. What we put in, it's implying that we'll take 1.8 out of the ground this winter, which would be on the low end of all, these previous years, except for the 2015-16 winter, which was extremely warm. So it's, to me, first of all, I look at this, it doesn't add up. I hear a lot about the production story and how much more production we have. Absolutely. However, production and the gas system has problems in the winter. And to just count on all of that production being there is a little bit aggressive at this point. But then I took these colored bars, right, that were on this previous chart, the end of winter inventory level, right, and kind of took a look at a summer winter spread. So stay with me here, Mike. I looked at June versus December.
That's June of 19 versus these 19, right?
Well, any June, right?
Oh, okay.
So
I see. Yeah.
Historical time series, but yes, for the current one, right? It would be,
okay.
And kind of placed where we ended up in winter, for each year, and versus where the spread moved. And why is June DEES interesting? I could take July DEES or May DEES, whatever. But the point is, one is a summer month and one is a winter strip month. When you have so for example, let's take the end of 2016. So at the end of winter in 2016, we still had almost 2.5 BCF in the ground. Meaning there's not a lot of incentive to get more gas in the ground, right? Nobody, like, the front dies, right? The spread, the value of putting, gas in the summer, it just declines relative to winter, right? And we can see that this June was under December by almost $1. Versus in years, so we'll take at the end of 2014, we ended that season with 830. You can see how tight that spread was, right? Because price had to move to a level in the summer to ensure that people put gas in the ground. And you can even see that here in 2014, how elevated the summer prices were, merely because we ended the year with such low inventory levels. This year, we ended with 1.3 BCF. Prices were low. They were at levels they had been when we'd ended inventory at much higher levels. We put, we put 1.8 in the ground at those levels. So will we have enough, are prices at this level really enough to get us to refill inventory if we end below 1.3 BCF. I know, Mike. I might have made a really, really simple story really long. And bottom line is, it's worth looking at summer. So let's circle back to here. It's worth looking at summer, and particularly I've been looking at summer straddles. Number one, volatility is below 30%. Number two, if we do end inventories really low, and all of a sudden, we have cash prices that gap up into the $350 range in order to, incent production to refill storage. The straddles are priced at a level right now. I think you can, for example, if you look at the May and June, at the money straddles are around 40 cents. Putting that on your books now gives you they're not going to zero tomorrow, and they give you a lot of lead time to trade around them. But
can I just ask you, are you looking, that is if you buy them and trade around them, or if you sell? Okay.
So 280 straddles, right?
Yeah.
No, but people think they look rich at 40 cents, right? Because now you're talking a range of 240 to 320. And
right.
Isn't that the exact fence costless collar,
Yeah, very close. I was looking at 250 puts. You said 240.
Yeah, so right in there, right? I mean, that's the range everyone is expecting.
Yeah.
And I would suggest it's worth thinking about this a lack. If winter can't perform from here, it's such a production story, and things are even more bearish than one would have expected. And we could easily see below 250. If storage really gets out of hand come first quarter, we could easily see summer above 3.25. And so it kind of gives you the ability to hang in there for either side of that, because the winter straddles are so they're priced to perfection at this point. And it kind of gives you, the ability to be in the market, kind of take a look at the next thing before the rest of the market starts taking a look at it. Everybody's focused on winter right now, but I've seen in the last few sessions where they're actually sort of selling out of some of the front, and I've noticed some nibbling in some of the summer months. And I don't know. I just think there is there's potentially something in the works here. Once people start to think about how does this current environment filter through to summer prices.
Yeah, especially if you're even just day trading, you're just scalping natural gas. It just seems, based on the premiums of these options, based on all the movement we had, that a lot of the move in natural seems to be played out for the first quarter. Yeah, we still may have moves, we still may have weather, but in competing against other traders, everyone looking for an edge, I'm not sure where the edge is when option premium that is so fat. That's why I kind of like the idea of going where you're looking at in terms of the next season. It just seems like we haven't yet seen positions go in there, and it seems like there could be a lot more edge, even if you're day trading, but to try to fit something in that time horizon.
Right. I mean, whether it is the implied vol changes, or whether it is that we get a huge failure in winter as a season, right, in weather, or we get another big explosion on that. I think it's hard right now the probabilities and the option values in the front of the curve. You're spending a lot of money. And for sure, right, you're going to be trading around that on a daily basis, looking at the front of the market. selling or buying call spreads. There's enough of a call skew out there in the market right now. But I think I just wanted to put this out there. I know we talked long before like the Feb March started moving as a spread, right? We didn't know when, we didn't know at what point, but that's where, people were going to run to based on, how the spread performed in the previous winter. And we've seen a lot of volatility in that spread. And today it's back down on the low end. And that's a good day trade, spread to day trade, Feb March, right? It kind of is bouncing between 30 and 40, almost as a bull bear sentiment. So, but now it's also time to look forward and maybe put some things on your book that aren't really going to cause you a lot of, P&L damage, but give you, the chance to be in for when that season hits people's radar.
Yeah. Can I ask you if you ever did something like this when you're either at some of the shops you've been with or, going solo? I'm looking at the April straddle versus the May straddle in natural. I actually looked at this a little bit earlier before we went on the air, so I don't know what the exact change is, but I was looking at something such as selling an April straddle. At the time it was like 44 cents, and buying a May straddle, which at the time was closer to 40 cents. Is that something that appeals to you? Selling a front month straddle, buying the following straddle. When I say front month, selling the first straddle, buying the next one. In this case, April, May, or May, June.
That's an interesting question. So the way that I have played, I wouldn't sell a straddle against a next month straddle. Okay. But I would, and let's move it up one to March, April, right? The March, April spread, future spread. Certainly there are a lot of people that trade that spread, whether they, sell March, buy April, and then they play the options in the reverse, right, as protection against any blowout or movement in that.
Or if they're short during that blowout, they're rushing to find something there, to buy.
Yeah. So I've traded the future spread against option spreads. I would say whenever I've run, a lot of money for specifically an energy company, I would be way more inclined to own straddles all the way out the curve and trade, an entire position around them versus sell them. You hate to give away opportunity like that. And you can always short the front, you can always do something in flat price to kind of get yourself, if you're losing too much value on those straddles. It's just, they haven't been of interest for a long time. Not in my wildest dreams would I think of buying a summer straddle. I wouldn't sell it either because, why give that away? But just as there was potential this year for the winter to move, I think there's potential for a case that the summer might fall outside of the 250 to 3.25 range. Not meaning at delivery, but prior to getting there, right? I think there's a chance for some volatility either way, based on either a massive letdown of winter or another surprise. So I know we only have like 2 minutes left here. There's so much going on and so many people, looking at the macro and will this and will that, interest rates, OPEC, weather and natural gas. And a lot of those things have gotten so fully priced right now that unless you have a serious edge in information flow on that, you're going to get caught, unless you have a massive weather edge and you have pipeline flow models and you see everything that, that's happening in the spot market in natural gas, or, you have a direct line in to, the OPEC meetings or, to what Trump is going to tweet or interest rates. It seems like it's a maybe a good time to, take that all off the table and look a little further out the curve to position. I guess that would ultimately be the theme of this one. And this example is in natural gas, but it certainly exists in oil as well.
Hey, Brynne, one last thing really quickly. Did you see crude just bounced? It got down to 50.08, now just 51.25. I'm not sure if there was any news out there, or that was just a bounce off a powerful whole number like $50. But market's coming back here.
Yeah,
so,
and you know,
yeah.
For sure, it was. Look, if you had puts on overnight. Speaking for myself here, it was almost nearly impossible to monetize them. And even in stocks, nobody wants, the muscle memory of this market is that it's so orderly during the regular daily session.
Yeah.
So, there isn't these huge gaps down where there's just nothing there, right? They're real orderly moves up and down that nobody really wants. They don't want the puts. I mean, they already, we're already pricing in what's happening today.
Yeah, so you can buy a put, you can have a nice drop, a significant drop, and your put's not performing. Yeah, because it's so
at least that was. I mean, look, I noticed that. I mean, at 5 a.m. the puts at 5 a.m. this morning in crude were bid more than they are. Well, I mean, I guess I haven't looked in the last 30 minutes while we're talking, but I mean, you can just, it's such a sign. You can just so tell how people are, they know some bounce is coming, right? Because we always there's always a savior, right? There's always a savior that seems to show up. And so, like, what are you going to do now? You can't buy calls. The vol will get destroyed when we move up. Puts, unless there's another leg lower, coming down from here, now you're left just in the outright market. Some people love that in this kind of vol, and in other cases, it's better to move your timeline forward. So, all right, I know Michael said 11:55, and I think it's 11:56. So, hopefully, we just at least gave everybody some ideas to think about for, maybe take yourself out of some of the noise right now.
Hey, thanks, Brynne. Good talking with you.
You too. Thanks, Mike, for being here.